This evening we're on chapter 7 of the Georgia quiz we just started. How are employer paid premiums on a group life insurance plan treated for tax purposes? As a personal expense paid on behalf of the employee. Well, it can't be paid by the employee if it was paid by the employer. So that doesn't make sense. As compensation in lieu of cash.
I think it's C.
As an ordinary and necessary business expense, a barter transaction. C like cat.
Yep.
Employer paid premiums on a group life insurance plan are treated as an ordinary and necessary business expense, which is why it qualifies for tax deductibility. If no beneficiary is living at the time of the insured's death, the benefit will automatically be paid the funeral home into the insurer's estate, the deceased spouse to the next of kin.
Okay.
And actually it'll go into their estate and they'll let see what happens is the estate is a legal entity and the courts will then determine how that legal entity is dispersed. So if there is no living beneficiary, it goes into the estate, which means that it has to go through probate, which means it's going to be a headache. So you should always make sure that your clients have their beneficiary forms up to date. Policy owner may name the estate as a beneficiary or by default, if no beneficiary is living at the time of the insured's death, the benefit will automatically be paid into the insured's estate. If a policy owner unintentionally pays premiums in excess of the Met guidelines, the excess premium can be refunded by the insurer within 60 days after the blank. End of the calendar year, end of the tax year, latest premium payment was received, or end of the contract year. Oh boy, I don't know that one.
Neither.
I think calendar.
You think calendar? I think it's either tax or contract. Within 60 days after the latest premium payment was received.
Contract.
You're going to say contract too? All right, let's see. Yeah. The policy owner unintentionally pays premiums in excess of the Met guidelines. The excess premium can be refunded by the insurer within 60 days after the end of the contract year. So the way we can deduce this is calendar year is going to be different for every single person, meaning in relation to when they started. Tax year is going to be different for every single person in relation to when they started. Latest premium payment was received, it could be, or at the end of the contract year, it could be. So we now know that they have until at the end of the contract year, they have to settle out. So think of it this way, if they could have paid $100 one month, $500 another month, $1,000 another month, $300 another month, and not really had any idea how much they paid. And at the end of the year, they can get information on just how much they paid, and at that point, they can receive the premiums back.
Okay.
Hey, Rashad, how are you doing?
Hey, I'm doing good. How about you?
Good. All employer paid premiums for amounts above blank, a group life insurance, are reported as taxable income to the employee. Oh, I remember seeing this. So Rashad, the strategy that we utilize to study is to review the questions and do the best we can. I know most of the answers, but I don't know all of them. So do the best we can to deduce the answer. And then but what's most important, because this is what you can do yourself, is if you get a question wrong, read the question again, and then read only the right answer. So I just vaguely remember that the answer to this is 50,000. If they had put 0, I probably would have gotten this one wrong. but I have a recollection of 50,000 in relation to this question. So all employer paid premiums for amounts above 50,000 of group life insurance are reported as taxable income to the employee. Okay, so that makes sense. So the employer is paying huge amounts of premiums. So these are like payments. So they're paying almost $5,000 a month for the employee. What they basically are doing is they're overfunding a life insurance policy for the benefit of the employee. And so if IRS doesn't like you to take too much advantage of life insurance policies. So I imagine that's why they do this. And I think it's 50,000. Anyone else remember anything different?
Nope.
All employer paid premiums for amounts above 50,000 are reported as taxable income to the employee. Under ERISA qualified plans, which is a qualified retirement plan, plans must meet all of the following requirements except, okay, remember, except is always going to be a tricky question. Except they discriminate in favor of highly compensated employees. So under ERISA plans, they must meet all of the following requirements. They may discriminate in favor of highly compensated employees. That's not true. So I'm pretty sure A is the answer, but let's confirm that these are true to make sure that we didn't get the wording wrong. They must have a vesting requirement. True. Makes sense. Must benefit employees and beneficiaries. True. Must be approved by the IRS. True. So we know that qualified plans cannot discriminate in favor of highly compensated employees. In other words, the executives can't put all kinds of money into these plans and then not have the regular folks do any. So under ERISA, qualified plans may not discriminate in favor of highly compensated employees. If a life insurance policy does not pass the blank pay test, it will be deemed a MEC. Somebody remember what number that is?
I always want to go with 3.
It's the name of it is called the 7 pay test. So just remember 7 pay MEC. Just associate the number 7 with modified endowment contract. What a modified endowment contract is you're allowed to put a certain amount of cash money into the cash value of a life insurance policy for tax purposes. But if you put too much money, if you start to take advantage of the right, then that's when they start to test you. They start to tax you. And this test that they do is based on how much money you're able to get into the policy within the first seven years. So that's called the 7 pay test. So just remember 7 pay MEC, modified endowment contract, which makes life insurance taxable. If a life insurance policy does not pass the 7 pay test, it will be deemed a MEC, modified endowment contract. Which of the following best defines the cost recovery rule? The earnings on the policy's cash values are taxed every year and built up a cost basis which is recovered income tax free upon surrender. No. Income tax free upon surrender. That doesn't sound right. The amount of the policy's internal expenses plus the life producer's commission make up the total cost of the policy. When a policy is surrendered, the earnings within the policy are accounted for first. Generally, the difference between the amount of cash value received and the amount of premiums paid in is subject to income tax upon surrender. This is definitely true. So what this means is if you put in $10,000 into this life insurance policy and it's performed really, really well, and you've made $100,000 and then you end the policy, you're going to actually have to pay tax on that extra money because it's no longer life insurance. The death benefit is gone, so it's not life insurance. So now that $90,000 that you made, quote unquote, is subject to income tax. Now I'm using a big number, but in reality, if you have a policy that you've been putting into for years, the numbers could be astronomically large. To give you an idea, a 10-year-old girl, 10-year-old girl, $100 a month, for her lifetime will put in $96,000. By the time she is likely to pass on, she could pass on $3 million to the next generation. If she decides to take the cash value out instead of, so in other words, let's just say at one point in her life, there's $1 million of cash value, and she's put in, let's just use the same numbers. We'll just use round numbers. She's put in $100,000 and she has $1 million in cash value, which is realistic for a child's policy. They can access some of that $100,000 in the form of a loan, which is tax-free. But if they end the policy and they say, you know what, cancel the policy, give me my money, all of that gain, all of that $900,000 is going to be taxed at income tax rate, which means they're going to lose approximately $250,000. So in other words, you always want to take a loan. You never want to surrender. And then, right, surrendering a life insurance policy with cash value buildup greater than what you've paid in. So what they're saying here is this cost recovery rule means that you get to recover the cost, your cost basis. The amount of premiums paid is similar to your cost basis. So let's see if I'm right. Yes. The cost recovery rule stipulates that upon a partial withdrawal of cash or the surrender of a policy, the cash value in excess of premiums paid, cost basis, is subject to income tax. ERISA requires which of the following? So now this is a positive. This means something that ERISA, again, remember, is the qualified retirement plans. For example, an IRA, 401k, 403b, these types of plans, they must meet which of the following? That employers establish a pension plan for their employees. No, we know there's no law to require pensions, although it would be nice maybe if there were. Employers must be able to benefit equally with the employees and beneficiaries. No, they can't benefit equally. Well, let's put this one on a maybe. That every plan has the same vesting schedule. Qualified plans must meet certain minimum standards. Well, D seems so obvious. Yeah, they have, that just seems, yeah, ERISA requires that qualified plans must meet certain minimum standards. But apparently none of these three are one of them.
Mm-hmm.
When a life insurance policy does not pass the, wait, didn't we just get this question?
Yeah.
Oh. Anyone remember the answer? 7, there you go. It is the 7-pay test that must be passed in order not to be classified as a MEC. Which is 2 regarding the taxation of the cash value in a universal life policy prior to withdrawal. Tax deferred, tax interpolated, tax deductible, tax free. So we actually had this one last week. Does anyone remember it? Oh, I'm sorry. I'm highlighting it.
Yeah, wait.
Yeah, tax deferred.
The real one's new. We've heard that.
Yeah, so it's tax deferred. So what this means is you might actually end up being able to access that money tax-free, but the way they call it is tax deferred because you don't have to pay the taxes yet. And then depending on how you access the money, you may never have to pay taxes on it. So they call it tax deferred. So if we're actually going to correctly say, we can say that life insurance, the cash value grows tax deferred, you're able to access it income tax free, and it passes on to the next generation income tax free. The reason why they say deferred is because, let's say, for example, you end up surrendering the policy, then that money did not accrue tax free. So it was only tax deferred. So just, that's actually an important distinction. All life insurance cash value accumulations are tax deferred. The primary benefit of universal life is the potential of a higher interest crediting rate than the fixed rate and whole life policies. And this is why we're big fans of index universal life. All of the following regarding policy loans are true, except policy loans are taxable if the policy remains in effect and the amount borrowed exceeds the premiums paid. False. That's what the beauty of policies is, they're tax-free. Policy loan is not taxable so long as the policy remains in force. True. Remember, surrendering is bad. Policy loans good, not taxable. Policy loans cannot exceed the amount in the cash value. Oh, these are, okay, see, I just got caught. Except, so we know B and C are true. Loans can exceed the cash value. The interest on a policy loan is not deductible. That makes sense. So policy loans are not taxable, so we know that it's A. Policy loans are not taxable. So, right, if the policy lapse, oh, go ahead.
No, it's so simple. It's because policy loans are not taxable. I kept thinking it was taxable, but it's not.
No, loans are, just think of it this way. If you go to the bank and say, okay, I'd like $100,000 for a mortgage, and they hand you $100,000, do they tax that $100,000? No, loans are not taxable. Similar in the IRS code, they decided a long time ago that widows should not pay tax. So life insurance is not taxed. So as long as it's defined as life insurance, it's not taxed when it passes on to a beneficiary. The wealthy have run with this and utilized it in all kinds of crazy ways to benefit themselves. Blank plans do not meet the requirements of federal law to be eligible for favorable tax treatment. Do not meet the requirements of federal law to be eligible for favorable tax treatment. So qualified plans, we know, do meet the requirements. Non-qualified plans are not qualified, so that means they do not meet the requirements. ERISA does meet the requirements. Pension does meet the requirements. So the only answer that does not meet the requirements would be non-qualified. I have a question. Which is more helpful, for me to walk through the logic of it as I go, or to have you guys guess, or a little of both?
Both.
Okay.
And both.
To be a qualified accelerated death benefit, it must meet all of the following criteria except. So it must meet these requirements. A physician must give a prognosis of 24 months or less life expectancy for the name insured. That's true. The insurer provides a monthly report to the insured showing the amount paid and the amount of benefits remaining in the life insurance policy. That's also true. The amount of the benefit must be at least be equal to the present value of the reduced death benefit remaining after payment of the accelerated benefit. Okay, so the amount of the benefit must at least be equal to the present value of the reduced death benefit remaining after payment of the accelerated benefit. That sounds good, but it's confusing, so let's go on. The benefit amount cannot exceed the lesser of $50,000 or 7.5% of AGI. This is just not true. So even though this one is confusing, just remember that when they start talking about qualified accelerated death benefits, cannot exceed the lesser of 50% or 7.5% of AGI. No, you can definitely get more than $50,000 from an accelerated benefit. So that has to be false. D. Let's see if I'm right. Pretty sure I'm right. Yep. To be a qualified accelerated death benefit, the benefit must meet the following conditions. A physician must give a prognosis of 24 months or less life expectancy for the name insured. The amount of the benefit must at least be equal to the present value of the reduced death benefit remaining after payment of the accelerated benefit, and the insurer provides a monthly report for the insured showing the amount paid and the amount of benefit remaining in the life insurance policy. So we are now done. We answered all 15. We think we got them all right. 100%. Woohoo!
Yes.
So it's 7:30. We're now on chapter 8. Let's dive into this a little bit, but we're not going to try to get through it, and we can pick up the rest of this on Thursday. So this is health insurance basics. Introduction to health insurance. Why is this? Do we need this? Let's see. Georgia Life and Health. Is Georgia might be one of those states that only allows you to do life and health. There should be a way, guaranteed exams.
It's like in chapter 9.
Yeah, some states require you to study both. I think Georgia's one of them. But if your state will allow you to sign up for an exam only life, do it. The health part will just confuse you. So we're going to run through this. I'm going to try to get as many of them right as I can. But unless your state requires it, you shouldn't have to do this. Not most states. Most states do not require it. Introduction to health insurance, learning objectives upon the blah, 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 right? So we're going to read questions. Which party to a health insurance contract is responsible for making the premium payments? The producer? No. The beneficiary? No. The policy owner? Maybe. The insured? Not usually. So it should be the policy owner. Does that make sense to you guys?
Yes, it's very clear.
By definition, the policy owner is responsible for making all decisions regarding the policy and maintaining the policy by paying the premiums. The insured may also be the owner, but is not a requirement. Match the following terms with the correct definitions. Oh, fun. Health insurance benefits. Let's see. Let's go this direction. The person who controls the policy and maintains the rights to make all decisions regarding coverage. It was the last question. Remember what it was? The person who makes all the decisions.
The policy holder?
Policy owner. Yep.
Owner.
A spontaneous, unforeseen, and unintended event resulting in injury. An spontaneous, unforeseen, and unintended event resulting in injury. Accidental bodily injury. And all of the words are in the definition, so that was pretty clear.
Mm-hmm.
A relationship that must exist at the time of an application in which an insured's sickness or injury would result in a financial or economic loss by the policy owner. It's the same as in life insurance. The options are health insurance benefits, insured, sickness, insurable interest, and beneficiary. So it's a relationship that must exist at the time of application. Most of the time, so I say again?
Sickness? He said, relationship.
Oh, but must exist at the time of application. So in other words, a sickness would not work because that would disqualify them from getting the policy most likely. So the other hint in this is in which an injury would result in a financial or economic loss by the policy owner. So same as life insurance, what that means is they have an interest in the insured, or what's called insurable interest.
Insurable interest, okay. Yeah.
An illness or disease that occurs after a policy is issued is a health insurance benefit, an insured, a sickness, or a beneficiary. It's really an illness or disease that occurs after a policy is issued is a sickness. The individual specified in the policy was eligible to receive benefits upon a loss suffered by the insured. Same as life insurance. So the person who will get the benefits if the insured suffers a loss. That should always be the beneficiary. Beneficiary is always the one who benefits is going to be the beneficiary. Individual covered for a loss under the policy.
Insured?
Yep. Health insurance benefits may include payments for disability income, medical, hospital, and surgical expense reimbursement, dental expenses, accidental death and dismemberment, and long-term care expenses. All of those fall within health insurance benefits. An application for health insurance is completed by a producer and signed by the applicant. The applicant remembers information that needs to be added to the application before being submitted to the insurer and contacts the producer who has returned to the office. Which of the following statements is correct? The applicant will have the opportunity to correct any information when the policy is delivered. That doesn't sound right. The producer must meet the applicant in person to update the information and have the applicant initial the changes. That might be right. The producer can make any changes necessary with verbal consent of the applicant. Absolutely not. Don't ever change an application or sign for an insured. Once the application is signed, answers reported to the application cannot be changed. That's not true, but this is of course a little bit different now. In person is not 100% true anymore, but the implication I think is historically true because they do have to initial the changes. So that's the important part. So don't get caught up in this wording that they haven't updated it since we're now doing Zoom almost all the time.
Yeah.
Changes can only be made to an application with written consent of the applicant by initiating the changes or updates. If an incomplete application is accepted by the underwriter and a policy is issued without requesting the missing information, which of the following statements applies? The insurer can avoid the contract at any time since it is considered fraudulent. No, that doesn't sound right. The producer will be personally responsible. We stop right there. That's not true. The insurer waives its right to consent a claim based on the incomplete application. The policy can be contested if a loss occurs within 2 years of the policy being issued. So this is a thing. Within 2 years, if they find an error on the application or find out you lied, or without requesting the missing information. This is a tough, I think it might actually be C. If they accepted it with the missing information, that is not the insured's fault. So they have to take the responsibility, I'm pretty sure. So I think it's C. Anyone else have an opinion? I think it's C. The insurer waives its right to contest a claim based on the incomplete application. If the insurer issues a policy based on an incomplete application, it waives the right to contest a claim based on any missing information. Oh, this I will say, try to always do a conditional receipt in life insurance as well. What this does is, let's talk about it in terms of life insurance. If someone does an application and then doesn't pay, and then they, God forbid, die before the policy gets issued, then the beneficiary is out of luck. But if the person dies in the process, has paid, they will continue the underwriting process. And if they were going to get approved at any level, then the insurance will pay out. So instead of being insured from time of approval, if they're ever going to be approved, then you want to, then they'll get, then they'll be covered from the time of application, which is really important. So especially sometimes this underwriting can take a while. So it's sort of like, okay, they've done the life insurance application. They've done everything. Just make sure you get, for us, what we need to do is get their routing number and account number. That just means that in the next 2 weeks, 4 weeks, 6 weeks, however long the underwriting process takes, if they get hit by a bus, they're going to continue on and they will pay it out if they get approved at any level. If a premium is submitted with the application and a conditional receipt is issued, coverage is effective the date the policy is issued and mailed to the producer, the date the insured or owner signed the policy delivery receipt, the date of the application or date of a completed medical exam if required, whichever is later, as long as the policy would have been issued as applied for. The date the insurance company received the results of a required medical exam. When they say later, they mean older, I think. Or do they mean later is newer or later is older? Huh. I think whichever is older, later, that must be what they mean. So I think it's C. Because the key here is would have been issued as applied. Well, wait, no. Whichever is later, as long as the policy would have been issued as applied for. It's got to be B. Is issued coverage is effective. You know, it could be C. Maybe it is as if it's been approved as applied for. I thought it was at any level. Anybody else seen this before? Have you ever seen this, Ashton? Anyone have a guess? B or C? B or C? I think this is the most logical. It can't be this date because what if the person doesn't get approved? The only one that mentions if it had been issued is C. So I'm going to go out on a limb and say it's C.
Okay.
A conditional receipt provides that coverage is effective the latter of the date the application is signed or when a required medical exam is completed, not when the results are provided. Okay, so when they say later, what they mean is newer. So that means that if you sign the conditional receipt, but then you don't ever go get the medical exam because you know you have cancer and then you die, they're not going to pay. But if you did the medical exam and they would have approved you, they find out you don't have cancer, then they will pay it. So that does make sense. That does make sense. All of the following are individual underwriting factors except age, marital status, tobacco use, gender. Which one of these would not be an impact or would not be something that you could discriminate against?
Gender? Oh, wait. Yeah, you can't discriminate against. Wait, all of the following are individual underwriting factors except.
So actually, so I will just give you a hint. So you can discriminate based on gender in health and life insurance because statistically speaking, women live longer. So that's going to be a factor.
Okay. Oh, because this is health. Oh, I see what you mean about confusing.
The marital status doesn't ever matter. That's not going to ever be a factor. There is some statistics that say that married people do live longer, but that's not gotten into life or health insurance. Marital status is not considered an underwriting factor. Individual underwriting factors include age, gender, tobacco use, occupations, hobbies, physical condition, moral hazard, health history, and the plan applied for. Which of the following is the primary source of underwriting information? Investigative consumer report, attending physician statement, the application, or medical exam?
The primary source for underwriting is not consumer report. The application?
That's what I think.
Mhm.
The application is the initial source of underwriting and insurability. It is the first thing submitted to the underwriter and may include all information necessary to issue a policy, or additional information may be requested. So the point of this is they may not even request any of these other things, so that can't be the primary source, because you might get everything you need from the application. Medical Insurance Bureau, just so you know, they can access medical records, they can access medications taken. So that's not something that somebody can lie about, or they, if they take medications, they just have to be honest about it, because they will show up. Now, the only time that sometimes you can, I don't want to say get around this, but there are some times when people have prescriptions taken in there, but they might not take them anymore. But if they need to take them, then not taking them could be a bad thing. So the point is that they have that kind of information in there. Which of the following sources of insurability alerts members about an insurance applicant's previous claim information?
Previous claim information.
APS, yeah. Previous claim information, though. Yeah, I think MIB. The MIB Medical Information Bureau reports acts as an information exchange regarding an applicant's previous claims, representations, possible fraud, pre-existing conditions, hazardous hobbies or occupation, and other information that may make the applicant a higher risk. If a premium is paid at the time of application and a policy is issued as applied, legal delivery can occur at the time of. If a premium is paid at the time of application and the policy is issued as applied, legal delivery can occur at the time of application. That's impossible.
No.
Issuance of the policy, when a statement of good health is provided, completed medical exam. Delivery can only happen when the policy is issued.
Issued. Okay. Yep.
Legal delivery occurs when the policy is issued or accepted by the insurer only if the initial premium has been paid and the policy was issued as applied. It is at this point that a legal contract exists, since the issued policy is the acceptance of the offer. What we're finding here is almost all of these concepts are exactly the same as life insurance. I haven't found anything that's different. So if you study the life insurance, at least for this chapter, you're good with the health. But again, if your state doesn't require health, don't take it. If a premium is not paid at the time of application, the producer will obtain which of the following at the time of policy delivery? Notice of consent, attending physician statement, conditional receipt, signed statement of good health.
Conditional receipt.
That's done at time of application.
Okay.
Attending physician statement doesn't make sense. What do you think it is?
Notice of consent.
I think it's actually, so if they have not paid it before, then they have to claim that they're still healthy.
Okay.
So they have to sign a statement of good health.
Okay. Yep.
If premium is not paid at the time of application, the producer will collect the premium when delivering the policy and obtain a signed statement of good health from the insured, stating that there have been no changes to the insured's health since the time of application. Oh, this is fun. Determine if the following steps occur while the application is being completed, during the underwriting process, or when the policy is delivered. We just learned of this one, statement of good health.
Completing the application.
Nope. When
It's delivered.
that's right, policy delivery. The MRB report may be requested.
Underwriting.
Underwriting, that's right.
You don't see it.
Yeah, just yeah, anyone's free to guess at these. Rashad and Keith, go ahead. Feel free to jump in. Legal delivery. That makes sense that would be at policy delivery, right?
Policy. Just leave it.
Required signatures.
Completing the application.
Application, right? Producer explains rating, premiums, coverages, and policy benefits. Rating implies delivery. They've already approved it.
Mm-hmm.
Determine if the following steps occur while the application is being completed, during the underwriting process, or when the policy is delivered. Formal request for the insured to issue a policy. Formal request.
Policy delivery? No, that sounds weird.
No, it's a request.
Completing the application?
I think so. I think so. Yep. The classification of risk and rating happens during underwriting. Insurability is determined.
Underwriting.
Conditional receipt may be issued.
Complete the application.
That's right.
Know something.
See, once you start practicing this stuff and you start learning these words and these concepts, you can start using logic to get to some of these answers. It's just really getting used to the words, which is just the repetition, going through 80 Banker, going to these classes. But I really, really encourage everybody, go through the 80 Banker on your own and study this. If you don't have 80 Banker in your own state, you can use this one. All of the following are potential risks of replacement of an individual health or disability insurance policy, except. So if you replace it, what's a risk? Coverage may be reduced or excluded due to a pre-existing condition. That's true. Coverage due to an accident will be restricted for 30 days after the effective date of the policy. That might be true. Probably true. Maybe true. Premiums may be higher than the original policy. Definitely true. A new probationary period may go into effect, limiting coverage for losses due to sickness. That is true. A new probationary period may go into effect. Coverage due to an accident will be restricted for 30 days after the effective date of the policy. It's once the effective date of the policy is in force, then it should not be restricted. Okay. But they are saying that a new probationary period might exist. So I think, oh, wait. So this is the risk. Which is not a risk. Okay, let me read this again. See, these excepts always get me. All of the following are potential risks of replacement of an individual health or disability insurance policy, except coverage may be reduced. Yes. Coverage due to an illness will be restricted for 30 days after the effective date of the policy. I don't believe so. Premiums may be higher. Yes. A new probationary period may. Yes. So now this is something interesting. All of the following are potential risks. Okay, I think I might be reading too much into it. Anyway, I think the coverage due to an accident will be restricted for 30 days. I think that is not true. That definitive statement I don't think is true. Replacement of a policy may reside in higher premiums, true. Exclusions due to pre-existing conditions, true. Or probationary period limiting when losses due to a sickness are covered. Losses due to an accident are not affected by pre-existing conditions or probationary periods. All right, we are at the new exam. It's just about 8 o'clock, so we're going to pick this one up on Thursday. Any questions so far? So Rashad and Keith, what I'm going to do is I'm going to start including more of the Freedom Equity Group and Team Legacy, which is the team that we're a part of. They have a lot of training and a lot of information. And I'm going to start pushing more of that information out. If you're available when it's coming on, please jump on. If you can't, I understand. But what I'm going to be doing is at the beginning of these meetings, I'm going to start just doing a quick update on what's going on. Maybe do a little product training depending on the timing. But what I'm going to do is I'm going to replace the Wednesday meeting at 7 that we've been having with the other meetings, and then also going to deal with Tuesdays and Thursdays. When I first started this, we were doing it every day. And then I quickly realized every day was too much. And then I realized 3 meetings a week was also too much. So we're going to do Tuesdays and Thursdays, and then we're going to supplement it. There's life insurance training Tuesdays at 1. There's annuity trainings Wednesdays at 1. There's other things. There's opportunity meetings, and there's client presentations. So all of those are things that we can start getting additional training and training for. And I'll start making those more available via the text blast. Tanisha, I do have a text blast, which is mostly directed at my team, but if it does also announce when these are, but it will also probably, as I just said, announce some other FEG stuff. So if you can stand to get a few more texts, you're welcome to get those as well. Let me just put that in the chat.
Thank you.
Any questions, Rashad or Keith?
No. I'm fine. Appreciate it.
Okay.
No, I just
Go ahead, Keith.
I just got in the house. I was on the road just now. I was listening on the road. I just got in the house. No question.
Oh, okay,
Right
cool. Hey, Rashad, I'm going to give you a call tomorrow and give you an update on the policies, the underwriting process that are going on with the people you've referred. And I also have to, let me actually stop this.